Before we start this lesson, we got to give a round of applause because you guys have completed the blue rose tier of the trading course. You guys are now beginner traders and you all have the basic knowledge necessary in order to take this that step further. And that's exactly what this tier does. Now, the red rose tier, welcome. We are now red rose traders and we are looking at our smart money concepts. That is what it's called, the concepts that I trade. And basically throughout this section, we're going to be focusing on the tools that we are using in order to build our trading strategy and put together our trading plan. So what better place to start than looking at liquidity, and mainly liquidity sweeps, because we of course want to be looking at liquidity as a way that we can look to execute trades. But before we do that, we obviously have to understand what the heck liquidity is. So in basic terms, liquidity is a price point within the market that when it is hit, it triggers a lot of people entering or exiting the market. So basically, there's a lot of people coming out of the market because their stop loss will be getting hit, or a lot of people coming into the market because they are hitting their buy or sell orders. Oh my God, that was too hard to say. Now, liquidity basically rests at every high and low within the market. You may have heard of buy side and sell side liquidity. That is just a techie term for saying highs and lows within the market, pretty much. Like every high and every low holds liquidity, some obviously stronger than others. The time frame obviously will hold stronger liquidity. So an hourly liquidity will hold, hourly high or low will hold more liquidity than a 5-minute high or low, depending on where it is, of course. Obviously, you can have the hourly low at the same point as the 5-minute low, but that's just on a higher time frame. It works out to be like that. Anyway, we want to look at how we can actually use liquidity. So we are going to be spotting liquidity sweeps. That is what it is called, the concept. And in order to do so, I'm just going to chuck this into replay mode real quick and show you that obviously we have liquidity resting at all of these points going down the market here. All of these highs are liquidity points and potential areas that we could look to sweep and take a trade off. As I said earlier, if I move on to the hourly chart, we can see that this is actually a 1 hour sweep. I was obviously on the 15-minute chart, and this is also a 1 hour liquidity point as well. So we'll jump back onto the 15-minute and we'll play price forward just a little bit because I know price does run up here. And we are now just going to be focusing on this top one. So it was an hourly liquidity sweep. Obviously, I'm on the 15-minute chart just for the example. But as we can see, we moved above this hourly high that we had marked out on our charts over here. Hopefully all of my lines are visible. Sometimes they go invisible. It's a bit annoying. But we had an hourly high over here that price came up and then closed back against it. We can tell that it's a liquidity sweep based on the reaction from hitting that price point. So obviously we did have all those liquidity points coming down here. Is there liquidity at those areas? Yes. But how much liquidity determines how the chart reacts to it. So obviously we quite clearly easily closed above these points here throughout the market. So there's not too much liquidity on the way up there. But this point in the market did hold a lot of liquidity. So a lot of people's stop losses or a lot of people's sell orders were getting hit at this point. So once the market reached that area, we can see we rejected back to the downside from it. Now that we know that this is a confirmed liquidity sweep based on the way that price reacted from reaching that target, we can basically pay attention to how price then moves after the liquidity sweep. And if we press play, we can see that we do get that run down. So let's say, for instance, we were looking to take a sell. We would mark out this hourly liquidity. We would hit this liquidity point. Obviously, I'm not just taking a short position off of the hit or the tap of the liquidity point because there is more to confirm the move. But as an example, we can see that price hit this point and then dumped the opposite direction. So if we were looking for shorts, we potentially could have been entering in on this position and then executing and taking some profits. With that being said, I am of course trying to make these really, really simple. So another way that we use liquidity is not just for looking to enter into the market, but also to exit the market. So let's find another example real quick and we'll see where we potentially could have looked to exit the market when entering into a trade. So let's say, for instance, we are looking for a short off of this. So we get that liquidity sweep here from the 15-minute chart. We then are looking to take a sell position based off of other concepts that we will eventually be learning throughout this session as well. But we also want to look for liquidity points that can be used as targets. So obviously we know liquidity was resting here. That is what we were looking to get hit and move in our direction of our bias in order to execute a trade. But of course we need to exit a trade at the same time. And by doing so, basically doing the same thing, we can target liquidity So we have a 15-minute low over here. We can mark that as a potential target. We could also mark this as a potential target. Basically, we use liquidity for entries and for exits, and it's very good because why? People's stop losses and people's buy and sell orders are resting at these points. At these points, the market is going to change once it is hit, right? So let's say we get a sweep, break in the direction of our bias. We look to take a trade, execute on the way down. Boom, we are taking profits at this point right here. Let's just get rid of that one, make it look neater. This is where we're taking profits, okay? We take profits here. We are very happy with what we made and we don't get greedy. As we can see, yes, oh, but price moved down a little bit further. Okay, sure, price can move down a little bit further than where your take profit eventually was put, but price is going to react from that point. As you can see, what happened after it hit this liquidity? It stalled. It basically stopped moving down. It didn't want to move any further down because there's a lot of buyers at this point. As there was buyers at this point to push up, there's also buyers at this point again when price comes back down. All right, so let's quickly go through a few examples together and then you can go and do it yourself. As we can see, we are looking to mark out 15-minute liquidity points at this time. And then what happens? We get a liquidity sweep. We could play price forward, see what happens next. We did sweep it again, but boom, swept a low, went higher. We have another example here where we are trading lower. We have a 15-minute low get put in. What happens? We reach that point and then price moves higher. We trade down, sweep the low, and then price moves higher. Now, just to prove that this happens like literally everywhere, I'm going to show you this one live. We're just going to move back within the market and find a point that we can see. Liquidity rests at, liquidity sweeps, put in replay mode, liquidity resting at this high, liquidity sweeps it. Yes, as I said before, the wick basically proves, and the reaction from hitting that price point basically proves if it is a liquidity sweep. If you do get a little close above, we can just wait for that next candle, see what happens after that. As we can see, we did continue down and pushed price lower throughout the market. So that is still a valid liquidity sweep. But again, as you can see, it happens over there. We can move over this way and we can find that it happens over here as well. We have highs put in over here. Price comes up, sweeps it, dumps further down, right? It happens literally everywhere. This is how the market moves and this is how you make money within the market. You have obvious points of liquidity, obvious highs, obvious lows. 15-minute low here. Price sweeps it, pushes higher. We can go over here. 15-minute high over here. Price sweeps it, pushes lower. Again, it's literally everywhere. You will be able to see these in your fucking sleep once you have just practiced this a whole bunch. 15-minute low. Price comes down, sweeps it. We probably get our breaker structure, retest, anything we need, confirmation, boom, goes higher. Obviously, we haven't learned the breaker structure and the retest and all that stuff yet, but we will be getting into that within this red rose tier. So definitely be looking forward to that. But that's pretty much liquidity. Hopefully I made it very basic for you guys. It does not have to be hard. It is, you find a high and a low. You basically find a high and a low. You wait for the market to reach that point and you see how it reacts from there. That is a liquidity sweep. The market moves to these points constantly. As we can see, it is always hitting highs and it is always hitting lows and it is always reacting off of them in one way or another. I mean, look at this. Just by zooming out, we can literally highlight there is 3 liquidity sweeps that I had put in right here. 1, 2, and 3, right? What I want you guys to do now is I want you to jump onto 3 different pairs and then I want you to identify 5 different liquidity sweeps. Basically, mark out highs, mark out lows, see how price reacts after hitting those points. Identify 5 on 3 different pairs. You'll be able to see it super easy after practicing this, and then we'll be ready to move on to the next thing. You can of course do more. It's going to become very, very simple for you. There also find some examples where it's invalid, like for instance when price has an obvious high over here like so, but then the market comes up and we don't quite get a sweep and it continues a little bit higher. So find a couple of examples of invalid liquidity sweeps as well if you would like, but I really want you to pay attention to liquidity, getting swept, and literally write it down what happens after it tapped that point in the market. Take note of it, take a picture, add it to a journal, do whatever. That is your homework for lesson 1. Hopefully you enjoyed it. Let's go on to the second one.